So 760 is really what we're seeing as being that like gravy area now, where most companies will stop. Like you could get preferred pricing if you have a 760 or above, but so it's moved up about 40 points in the last 5 years or so.
Welcome to Get Real 411, the podcast where real experts give real advice on all things real estate. I'm Jamie.
And I'm Brad.
Join us as we explore real estate successes and pitfalls through the eyes of our esteemed guests.
Now let's get real. Today we welcome Sam Parker from My Credit Guy. Here is somebody we've been really excited to bring on the show for quite some time. He's such a busy person. He flies all over the states and he helps people with their credit. So we're super excited to have you for a little bit of time today to talk to you about how people can improve their credit, maintain their credit, and get the best rates on any type of financing, whether it's car, consumer, or mortgage. So welcome today, Sam. It's great to have you.
Hey, thanks so much for having me, guys. I'm big fans of both of you. So when I got the invite, I was so pumped, and I'm glad to be here. Thank you.
Oh, we're so glad to have you. You know, you've been a friend, and I think we've been mutually cheering each other on for, a decade or maybe even more. And so I just always enjoy seeing what you guys are doing. And it's been a really neat thing to get to be a spectator and watch what you and Trisha have built over these years and what My Credit Guy has really become. And I think that a lot of our audience members are actually industry professionals in the real estate and mortgage side of things. And I think that in general, in our industry, there are a lot of misconceptions about what credit repair really is. And in fairness, I think there are probably some other organizations out there that have created that misperception. So if you don't mind, I've always respected the way that My Credit Guy does business, and I would love your perspective on what you really think a good, reputable, credible credit repair company should look like, and maybe speak to a little bit of the recent stuff that's been in the news to the opposite end of that spectrum.
Yeah, absolutely. Well, thank you for the kind words, first of all. And it's been our pleasure, knowing you and creating these success stories together. But basically, the credit repair industry is governed by the CROA, the Credit Repair Organization Act, and they do a pretty good job of outlining what you can and can't do. And unfortunately, our industry in general, for whatever reason, has decided to either try to skirt it blatantly or just disregard it entirely, right? So like in credit repair, you're just not supposed to charge up front. You're not supposed to lie and tell the consumer that you can do something that you can't do. That's about it. I mean, there are it gets more granular than that from those things, but it's basically just don't lie and don't tell the client that you're doing something that they can't do if they knew exactly what they were doing or had the time to do it. You can't tell the client that you can get things off the credit report that are accurate, like just things like that, right? And so when we built My Credit Guy, we wanted to work with homeowners because we want people to cross the finish line. And what we found was that number one, we wanted to be part of that journey. It just feels so good to help somebody become a homeowner. But number two, one of the things that our industry gets a bad rep for is that you got a lot of people that are signing up for credit repair because companies mislead them and say, hey, we can do all of this, right? When in reality, it's that the client most likely has accurate items on their credit report that are bad, right? Like there are definitely instances where something's on the credit report, it shouldn't be there. Of course, we can get that removed, no problem. But more often, there are times where you can see, and the saying that I have applies, good things happen or bad things happen to good people, and good people make bad mistakes. So most of the time what we're dealing with is we're helping a client kind of resolve something that they did do one way or the other, whatever the circumstances may be. And I throw my hands up to that because it's like, I get it. You got sick, your kid got sick, you lost, like, I'm not judging you. I'm simply telling you that your explanation of why this account went late isn't going to get it removed from the credit report because you agreed to make timely payments for X number of months at least this amount, and you didn't do that, and you didn't call into the company to apply for hardship, and you didn't make the payment, right? And so it's late, and so that's the setting that we like to operate on, where it's like, hey, let's not play make believe. Let's talk about what's going on your credit report. Let's talk about how it can actually be resolved, and talk about a way that you can be proud of your credit and that it will be rock solid going forward, because you're about to try to qualify for hundreds of thousands of dollars of someone else's money so that you can live the dream of home ownership with your family, right? Like, so these are significant things. Let's just build on rock, not on sand. So sorry, long kind of dramatic answer to your question, but that's what they do wrong, is that they charge up front, they lie, they mislead, and we just tried to do all the opposite of that.
100%. And Brad and I, longtime originators, not so much on the front lines of that anymore, but obviously we have a pretty big team of loan officers. And I think that, one of the things that we try to impress upon them is when you're dealing with a potential home buyer, things have been difficult, probably since 2020. Things have been difficult for people. You're going to come across people that might have more challenging credit than what you could have seen 5 or 6 years ago. We love to say that the answer is never no. Sometimes the answer is not yet. And when we say not yet, more often than not, we are sending our customers into the My Credit Guy sphere, because what we know about you is that, yeah, there are accurate things on people's credit that are really, really challenging. But what you're doing is you're giving them a tactical plan as to how to address them, to help them to impact their credit for as little amount of time as is reasonable based on the item. And that's a big deal. You're not out there saying we're just going to get this stuff removed. You're out there saying, let's really look at these items together. Let's decide what's valid. And then let me tell you what that means for you in terms of the timing and your ability to get to a point where you can qualify for the home loan that you want.
Absolutely.
Yeah. And it's not just about, the qualifying, because obviously, we all know this, Sam. I mean, you can get a loan with low credit scores with some derogatory credit, but you're paying for it. You're going to pay a higher rate of interest. And so sometimes it's also a plan. How do we get your scores up so you can get a better rate? Even if it's not today, maybe we get you home today, but then get you into a better rate later. Not just refinancing, but refinancing into the best rate possible. So one thing that I think is really a standout that I'd love you to chat about for just a minute is you, like you said, you kind of built the company with the focus of getting people into homes. You work with loan officers, and that is the one standout feature of My Credit Guy is you guys do such a great job of follow up and follow through, whether it's from somebody's just not calling back, a referral that a loan officer made, and you're now just updating the loan officer and saying, hey, help me get in touch with them. Because if we turn it over as an originator to you guys, we need to know that it's incubating, right? And ultimately comes back to provide them the financing that they need and deserve. And so most companies you give that referral to, they just drop the ball. You never hear from them again. Whether the client actually goes to them and does the work or not, you have no idea. But you guys do such a great job of that. So maybe talk about that, what systems you have in place for that today.
Yeah, well, first of all, everything is backed up by CRM, milestones, set in like whatever you decide in business, that these are my pillars. This is how it will be. This is how, if you come to work here, that mantra that you put out, that roadmap that you say, this will always be this way. There is no way for a group of humans to deliver that consistently. No way, right? And so if you don't back it up through your systems, through like your CRM and your LOS and having milestones that back you up, just help you be the person you want to be, then you're kind of setting yourself up for failure, right? And so that's number one. That's what we started was with non-negotiables, where we said, what are some things about my credit guy? Well, you must be a pleasure to work with. Something so simple though, but it has to be an underlying theme on everything, right? And so things like that then you build into your process, your people, in your CRM, it'll help you consistently deliver that. So what we did was we designed a roadmap where if we're delivering through empathy, and we said, I'm a frustrated homeowner right now, or not a homeowner, a renter. Somebody just denied me, which made me feel that small, and then they didn't call me back either. Or maybe they have a better process, but my viewpoint as a consumer is still, I was dealing with Brad. He said no. He said it nice, but now I'm about to talk to a credit repair company. And I'm going into each call like that, going, okay, even if Brad has done an amazing job of handing this off, this client's not pumped that this was the outcome instead of 720 credit score. You have the best approval. I can't wait to give you this money. It would be our pleasure, right? Like that's what we're hoping for when we have somebody pull credit. And so we built the company to acknowledge the psychology of a buyer or a borrower, a potential borrower, but we've also done it with our loan officers, where we said, what would happen if I sent my client over? What would I expect, or what would I want? And you have one of two things. You either have somebody that's like, I don't value them, I'm just going to kick them over, right? And what our system does is it teaches you to value them, because we remind you this is a human, this is transactable business here in a couple months, and all of a sudden you can start looking at these bad leads that you got as like, oh, well, that was a bad lead until I helped Sally and Tom get a home loan, and now these aren't bad leads, there's Sally and Tom's in there, right? And so you have those people where it's like, I'm just signing up because it's a system, but keep me posted. And then you have the people that are like, look, I get so in the weeds with this, and I'm helping each client, and I do the rapid rescores, and I do the what if simulators, and then sometimes they go with me, but sometimes they don't, sometimes they listen to me, and sometimes they don't. And I just go, how many people or how many realtors could you have talked to and helped in that meantime, where I'm over here doing the business, and they're like, right, but I want to help them, I want to pay for them. It's like, give them a credit closing then. Like tell them, if you do all this and you get through, I don't think you should do that. I mean, I think that it's it's their stuff they're cleaning up. But anyway, my point is, we deliver through systems and consistency what each loan officer and each client need and deserve. And because we have it in systems, delivering that custom path to each loan officer or each client is very doable at the drop of a hat. So sorry for the long answer.
No, that's good. Look, the reason I bring it up is it's been quite some time since I've personally referred your company to a customer.
Yeah.
But I literally got a call from one of your team like last week on somebody I think I referred maybe 6 years ago or somewhere around there. Like they literally do that. They go through and, give updates and keep you in touch with what's going on. So I think it's great from a loan officer perspective. There's no better company to refer to. Let's get to like just what it means to have good credit today. So it's been a moving target over the years. It used to be if you had 700 or better, you got the best rates. It was the best score. Then it went to 720, then 740. Like, talk to us about today. What are the different kind of credit brackets when it comes to applying for loans and getting the best rates? And how does that apply to mortgages versus, say, car loans?
Yeah, well, I mean, the crazy thing is it applies everywhere almost. I mean, anything financially that you do, there's most likely a credit component tied in. Even employment at certain points, and depending on what industries you're in, they're going to check your credit either purely to let you into that industry or that line of work or that licensing, or to allow for advancement. Like I know that we have a lot of people from the private sector that'll get a hold of us that need clearance, right? And getting that clearance is the difference between going from making 60,000 to making over 100,000 in some cases, or more. So insurance rates, auto rates, mortgage, everywhere, right? The end all be all used to be if you get over 720. I used to say if you're over 720, it's all gravy, right? And what I think has happened is that as the economy's gotten a little more stressed and as more allowances have been made on credit, like when they make it so that when you pay a medical collection off that it drops off the credit scores, they are going to have to be more strict somewhere, right? Like there's never, that's what when developments come with the credit scoring algorithm, I'm always like, there's an opposite side for every action. There's an equal but opposite reaction, especially when we're dealing with hundreds of thousands or millions of dollars of a bank's money, right? Like they're not going to go, yeah, you know what, everybody should just have a better credit score. They're going to go, well, now it's a 760. How about that then? Okay. So they're going to find a way. And I say they, like the banks, like the people with the money, they're going to find a way because it's all about loss mitigation, right? Like it's all about risk mitigation. Sorry. And so they're with the credit scoring algorithm, what they're doing is they're looking at you and that number that you end up with 760, 640, whatever, it's how likely are you to default on a credit line within the next 2 years. That's like what the question that's being answered. That's what that number means. So 760 is really what we're seeing as being that like gravy area now where most companies will stop. Like you could get preferred pricing if you have a 760 or above, but so it's moved up about 40 points in the last 5 years or so. In terms of a mortgage, I mean, you have companies that'll say, hey, we can go down to 500s and stuff like that, but and the thing is, I'm all about financial and mortgage strategy to build wealth through equity. I know that's a mouthful, but my point in that is like, I will take an 8% interest rate all day long to start building equity, right? And that's a whole nother discussion. But my point is, what people need to understand is that when they are getting qualified at those lower credit scores, even though you have an amazing mortgage professional that is finding you that money so that you can start taking advantage of that wealth growth through equity and owning your home, you're still taking hits along the way. You're paying more in PMI. Your rate might not be quite as good. You're paying little, just nickel and dime here and there usually when you have poor credit, right? Like it's just and just stress wise, it's just not as easy to get a deal done. There's usually a lot of other, okay, then we need to see this additional documentation, and then I know we're going to want to see this again, and we're going to need a letter of explanation on that because credit scores are lower, right? So in the mortgage world, they usually, at least the bank will draw a hard line, right? Depending on who you're dealing with. And they're going to say, this product requires a 640 or a 660 or a 580 or whatever it may be. In the auto world, though, that's where you get into some trouble because somebody is most likely going to finance you, right? And if you want a car, and that's the problem, is that with home ownership, the thing I love about it is that it makes you earn it, right? Like the process alone is like, no, you're going to have to fill some stuff out. You're going to have to submit some things. You're going to have to do some things that some of you aren't willing to do unless it's easy like that, right? Where with an auto loan, it's like, I want a car today. And if you're going into the world and saying, I want a car today, you're probably going to get a car finance somewhere today. And the interest rates in those situations can end up being even up into the high teens, very predatory, right? Where even like, I mean, high rate right now, and I'm not going to quote interest rates and on mortgages, never mind. But they're half of that. And the thing is, with an auto loan, then like that, it's just setting you up for the cycle of bad credit. Because if you get an 18% auto loan on, I'd hate to even think of what that car would be. It's probably not, it's not a new one. And so it has, you're on some corner lot somewhere with, the overhang, the places I'm talking
and
about.
the banners and all that. Sure.
Yeah. And they got you done at 16% with this 7-year-old Audi that don't worry, that the windows don't roll down sort of situation, which means in about 2 months, you're going to have a car that doesn't work. And then you're going to want to give that car back. And that's called a voluntary repossession, which is the same as a normal repossession. And now your credit just tanked. And now we're going on that. That's
and so look, the credit score bands have moved up. Like you said, it used to be, actually, I remember back when FICO, which we should probably explain what that actually is. It is a model that gets scored, but FICO scores, when they first came out, if you were 700 or higher, that was the top bracket.
Yeah.
Like that's what it was. And this was like in the end of the 90s, beginning of 2000,
Right.
if I remember correctly. And you can correct me if I'm wrong.
No, yeah,
But it's somewhere around there. And so that's where it started. That was the top tier. Now it's 760. You want the best rates, you got to be above 760. Then they're typically 20 point bands, right? 740 to 759, et cetera. So how does somebody, even if you got good credit, right? You're making payments on time, you never made a late payment. How do you get yourself into that top category? What are the strategies? What are real practical things you need to do?
Yeah. So number one, when you're getting up there, you have to pay attention to your revolving credit or your credit cards. That makes up 30% of your credit. And there's a lot of people that are like, oh, good, I'm on time all the time. It's not just being on time, it's being very strategic with your balance to limit ratios and the times of the month that those are reporting at certain areas. Meaning a lot of people, if they're getting a high credit score, they're probably doing well financially or better financially, which means they're probably playing the points game on a credit card, right? They're running up a credit card for expenditures and then paying it off. Cool, I do it too, but you got to be strategic and you have to know your dates. So number one, just by having that credit card over 30% of the limit, over 50% of the limit, you're costing yourself dozens of points in credit, okay? So having that credit card down so that it reports as being under 10% is going to give you points next month. It's going to be very quick, and with all credit cards. Okay, so if you have 4 credit cards, you want to get all 4 of them down if you can, because you're going to get.
So wait, you'd said 30%, but now you're saying 10%. So we're
no, he's saying that correct me if I'm wrong, that the balance to limit ratio makes up 30% of your overall credit score, and he's saying that the milestones where you're going to see improvements are having a balance that is less than 50% of the limit, having a balance that's less than 10% of the limit. Am I understanding you correctly?
Yeah, so it's 50, 30, 10.
Got it.
Big thresholds that make up 30% of your overall credit score.
Got it.
So it's almost a third of the credit score that's entirely controllable by the consumer just by using strategy and good habits. And the cool thing with credit cards that people don't realize is how much power is in them. Meaning somebody will be like, oh, I just have a couple little credit cards. It's all about your at-bats in credit. It's all about the ratios. It's a level playing field. Meaning if you have a $300 credit card and you keep it with a $30 limit, that's the same power in credit as having a $30,000 credit card and keeping 10% of the limit on that. So it's all just scaled, right? Scaled opportunities. So what somebody with that higher credit score wants to do is look at their credit cards, get as many of them paid below 50, below 30, and below 10 as possible. And the reason I say that is because you're scored on your overall balance to limit ratio, all your credit cards added up together, the lines and the balances. And then you're scored on your individual balance to limit ratio. So it kind of goes against pay down strategy, because a lot of times you're looking for that biggest credit line or the one that has the highest interest rate. What I'm doing when I'm trying to get as many points as possible is get as many individual cards below 50, below 30, and below 10.
And to clarify, when you say 50, 30, 10, if you're incapable of getting it down below 10, get it below 30. If you're incapable of getting below 30, get it below 50, because that's going to give you the most power, right? But ideally, if you're trying to get, if you've been, averaging 730 score or whatever, and you're making all payments on time, you want to improve that. What you're saying is get those balances below 10% of the limit. So what are some other strategies then to get, let's say that's just what you charge every month, right? You need to use it. That's what you're doing.
Yep.
What are some other strategies to get there at that 10%?
To get the
credit limits I'm referring
down.
to. Asking for higher credit limits.
Oh, yeah. Oh my gosh. Yeah. And I actually just did a post on that today, because it's a free way to increase credit scores, right? You call, especially if you're keeping good balance to limit ratios, call them right now. Or you can actually, if you log into any one of your accounts, you can go to account services, request credit line increase. It's going to ask for an updated income, and then you press go, and it'll be like, cool, we just did it for you. Or it'll say, at this time we're unable to, but if you've been keeping your balances low and paying on time, swing for it. I would absolutely do it. You can also call them up and ask for it, because then you could put a little pressure on and say, I'd love to keep doing business with you, but I got to have a credit card that allows me to make these purchases on a monthly basis. And I got another one offering it to me. So I just thought I'd check with you guys first, and they're going to go, oh no, please rack up debt on our credit card. Because when they do that, let's say that you had a $500 balance on $500 credit card. You're at 100% balance to limit ratio. You're getting an F in that section of the scoring algorithm, which means you're probably at best low 600s, right? Even if you have other things good happening for you. If you call up and you get them to raise that to $1,000, you just went to a 50% balance to limit ratio. And if that's like your only credit card and your entire 30% is being judged on that, you could very well have just got yourself 40, 50 points just by doing that.
Yeah, it's powerful
alone. Yeah. So it can be really good. And
you should do that every 6 months, shouldn't you?
Yeah, as long as you've been keeping your balances down. If you know that like my card's maxed out or I just had a late pay, like don't do it. You're just
it's not going to serve any purpose. But if you're trying to, but I guess my point being is that some people get frustrated. Oh, I make all my payments on time and I pay it off every month. But like you said, it's about timing. When are you paying that down?
Yep.
And if you want to get that extra boost, a lot of times that's just a matter of getting that credit limit increased. And you can do that if you're keeping that same habit. Every 6 months they open it up for you to ask for an increase. And that'll keep improving. Obviously I've had credit since I was 18 years old, and so I've got credit cards I don't even use that have $50, $60, $100,000 limits. And, I've got an abundance of credit because through the years, I kept asking for limit increases and I didn't really need it, but it's there. So talk for a minute about why you don't want to get rid of or close an account, which is another thing that people ask.
Yeah, absolutely. So if you close out a credit card, number one, and the most important, but the smallest section of the credit scoring algorithm is your payment history. 15% of your credit score is made up of payment history, meaning how long have you had your accounts open? Because banks want to see loyalty. Like they really do. I mean, this is honestly the section of the scoring algorithm where they're like, you better not break up with me. I will hurt you, right? And so if you do like what Dave Ramsey or some other financial guru says, and you close out all your credit cards, number one, you're changing the average age of your accounts across the board. And if you have thin credit, meaning not that many, more than likely that little credit card that you started with when you were 23, but you're annoyed because you got to pay the $67 yearly fee, that's probably your oldest account by far, right? And so when you close that out, it goes back into that average and it takes that 10 years out and it averages this 2-year-old account, this 5-year-old account, this 1-year-old account, and this 6-month-old account, and it took that 10 years out. And so you can't get that back. It's going to tank your scores, and there's just no replacing it besides having another account open for a good long time. On top of that, you're going to be affecting your balance to limit ratios in your credit card section, the one that makes up 30%. So let's say that I had 3 credit cards, $500, $500, and $1,000. Okay. And maybe I'm maxed on the 500 and the 500. And I go, that's just too much. I'm sick of credit cards. I'm closing out my big one. I don't even need that anyway, because you look at it as a liability and not as a tool. So you were at 50% balance to limit ratio across the board. You closed that account out. You ruined your pay history on it, or you lost your pay history. It re-aged. Plus now you're at 100% balance to limit ratio instead of 50% balance to limit ratio. Now you also don't have the positive pay history racking up every month in the 35% category. And you don't have a proper mix of credit that makes up 10% of your credit. So you got to keep credit cards are the simplest tool that you have to manage your credit effectively at almost no cost. I'm going to have to get gas anyway. Let me put it on a credit card and strategically pay it off. And the thing that we had chatted about earlier was knowing your dates, because a lot of people will be like, I'm frustrated. I pay my credit card off and my scores don't go up or whatever. Well, it's because they're paying their balances off after the credit card companies have reported their new information for that month. And then they're paying in the back half of the month when that information has already been submitted 10 days ago. And that's what you're being scored on. People think that your credit report just updates for you like 24 hours a day, like make a payment updated, make a payment updated. It updates in cycles. So you're going to want to change your payments instead of around the due date, which is probably the 15th through the 30th of the month. And you got to start making your payments between the 5th and the 10th of the month typically, because those reporting cycles where the credit card companies are sending their new information are usually somewhere between like the 12th and the 17th of the month. And so you got to get your new payment in so it reflects, so that you get payment for paying it off, because otherwise it might just be taking a snapshot of your high balance every month.
That's very good advice.
Yeah.
That is very good advice. That's something most don't talk about. And I guess the way you could really clarify when that is being reported is pull a free credit report, and maybe you talk about that. But pull a free credit report, take a look at when it's reporting for each of those accounts. Yep. And then my guess is you want to set your automatic payment up for like 5 days before that, right?
Yeah, exactly. Because you got to give it 3 business days to you have to understand all the BS that is cooked into payments, posting, and credit and all. Folks, it shouldn't be this hard, okay? I get that, but it's also not that hard either. Like once you understand a few of the like, okay, and then you just do it. It's like any game. You don't have to agree with the rules, but if you want to put points up on the scoreboard and there's a reward for doing it, sometimes you just got to do the thing. And really what it is, like somebody down the road that's way smarter might explain 5 levels deep. Well, the reason that we do it like that is because what we want to see is the reaction 3 months later, like, something weird like that, where there's like, there actually is a reason that it's like this. But if nothing else, it's just a flaw, and you got to know them, and you just got to use it, because the flaws can also be ways that you can kind of work the system.
Yeah, yep. Absolutely.
Yeah. Were you going to say? Okay. So, these are very practical tools people can use. And it doesn't matter. You don't have to have a 720 score trying to get to 760. All the same things apply, even if you have a really low score. The starting point is having a credit report that you can look at, right?
Yes.
And so what do you recommend for that credit report, that free credit report that you can pull periodically? What service do you recommend?
Yeah, so if you want your free one, you're going to annualcreditreport.com. You can pull one free credit report there a year, but it will not have credit scores. If you want credit scores, we actually have some exciting news coming up. Next week, we are launching Credit Sitter, which will be a 3-bureau tri-merge that you can get for $1 in some cases, free in some cases, and Identity IQ. We also like a lot. That's a $1 credit pull where you can see all 3 bureaus. After that, it does go into a monthly, so you would want to cancel if you're just trying to get a look. But if nothing else, annual credit report. If you're looking on, like, some people be like, what about like creditkarma.com? Here's the deal. I can get a good gauge off of looking at that report, and you can keep an eye on it too. The one thing that I'll remind everybody though is, in this crazy world we're in, if you don't pay for a product, you are the product. Meaning, you don't get a free credit score. You get a credit score that is paid for by partners having access to your information constantly. So just, if something's free, just remember it's not.
Absolutely. Well, I think this actually is a perfect segue, because we did want to hear about some of the exciting things that My Credit Guy is launching in the near future. And so if you would expand on those things a little bit and let our audience know some of the things that they might want to take advantage of themselves or create as a value add for their clients.
Yeah, absolutely. Well, we, just so everybody knows, we always have co-branded marketing for you: videos, flyers, credit education, all that good stuff. Product wise, within the next month, we should have MCG DIY hitting your app stores, where you will be able to come in, pull a credit report, see your negative items, challenge them on your own, at any time upgrade, and have the full assistance of a coach with my credit guy. But we're going to be able to provide that to anyone who's not looking for that concierge service and maybe who's not in a dead rush. They're going to be able to start working on their credit at little to no cost. So we have the DIY app coming up. Separate from my credit guy, and I have to make sure that I say that, I have partnered with Experian to create Credit Sitter, which is a credit monitoring service that's going to give options of both FICO and Vantage, updating anywhere from 2 to 4 times a month, and most services update once a month right now. So I'm going to be able to deliver at a much lower price point and deliver more often for updates, which is very important for somebody who's trying to increase credit, because right now what they're having to do is wait 30 days at a time to see what that update looks like, or pay another $40 to update their FICO, and we're going to be able to supply that at anywhere from probably $10 to $20. So it's going to be pretty exciting in that regard. And really those two alone, and we have some other ones coming up, but I'll just pump the brakes, because those two alone should really help us go from where we're at to just providing that next level service at even less cost than we do right now, and to the masses. So we really want to make sure that we're partnering for education. There's some really important things that are going to be coming up, which probably a whole other segment with FICO 10T and things like that. And we have just got to be educating our potential borrowers before some of these things happen, so that they're putting themselves in the best situation, and so that you're not dealing with 560s, then you're dealing with 660s, because you sprinkled a little bit of sunshine on them 6 months ago.
Look, that education that you're talking about, that you're pushing out, that is really the key. And starting that education at a really young age, so people understand, our youth understands what it is to build credit, maintain credit, and keep very good credit. Things will happen, like you said, bad things to good people. It will just happen. And somehow, some way, something might get reported. You had your credit card on auto pay and you changed banks and you forgot to go in to update the bank account and it missed a payment. There are all sorts of different strategies to keep that credit good, that if they're not aware of those, they're never going to be able to do those easy things to keep that way, to be able to then call to the credit card company and say, hey, look at my history. I've been on time every time for the last 7 years. Look, I went from this bank to this bank. This is what happened. I totally forgot to go in. Can you give me a break? And boom, they remove it, right? And they take the bad. So these are the types of things that through education you can help people on. I'd like to kind of move for just a minute on that idea of starting credit early with your kids.
Yeah.
What do you recommend there?
What I am going to do, I have a 9 and 11-year-old, and when they get old enough, I had to buy my first car. I love that story, but I'm not going to make them do that. Like, I've worked really hard. I'm going to buy them a reasonable first car. When I do that, instead of paying cash for it, I'm going to finance it at a super low interest rate, and I'm going to put them on as a joint user or as a co-borrower on that. That way I can control that. Now, let me say this to anyone who's listening and just heard use your child as a co-borrower. That is not what I said. I am not using them as a co-borrower. I'm helping to build their credit. And the reason I say that is because some people literally will say, listen, you need to let me use your credit to co-borrow. And I just want to make that clear. Don't use your kids' credit. So I'm going to put them on something that I'm going to make them make payments on it anyway. Like my kids, I'm going to help them get that car, but they're going to be doing things to pay me back, to build responsibility and all that good stuff. So I'll help them with training wheels get that first big installment loan. Then I will also put them on as an authorized user onto one of my credit cards that they are using, and that their efforts in my household go towards paying that off. Because I do not agree with adding people to authorized users just to add it to authorized users. I think it should be in the household or very close business partner type relationship. Otherwise, I think you cross over into that fraudulent area. But I'm going to put my daughters on an authorized user, if that's still a thing at the time. FICO 10T, take care of that. And if so, then I would help them open up a small credit card and I'd teach them how to use it correctly. More than likely, what I would do is if they're just starting out, and like, let's say at that time, Netflix is still a thing, I would have this small credit card paying off Netflix, and then I would have their bank account set up to pay off their credit card. And I would probably do that on 2 different cards. And then I would have that auto loan, and that's going to be enough right there to really start my girls off with strong, probably high 600s, if not coming up on that 700 range. And then when they want to start adding their own stuff and being responsible, it's going to be really easy to pop them up over 700. And
so let's reiterate this. So it's getting them on an installment loan. So like you said, that could be a car, it could be something else, but a car. So you're putting them on, you're applying, and you're putting them on as a co-borrower, right? Yep. And you have to make sure that you tell the finance company that you want it reported to their credit, because if you don't do that, sometimes it doesn't report, right?
Yep.
Then you're going to add them as authorized user. Of course, you made the caveat that new models, like FICO models or what have you, may not even help, so you don't know that, can't predict the future, but today it does.
Yep.
And the third is getting a small credit card when they turn 18, I'm assuming, right? Or some of them are 17.
I'm going to wait until they're 8. The authorized user will be fine until then, because then I can see every single thing that they're buying.
But the one credit card, but when they do that, it's typically a prepaid card, their first one, right? Or you get them like a Target card or a Kohl's or something like that that's easier to get. So maybe just to give people a little bit better ideas, or kids, get to be the late teens, what that exact strategy might be, because it's not just applying for a credit card, they'll probably get declined.
Yeah, exactly. And you just want to introduce it to them in a way that they can understand and be responsible for it at the time. Like, you hand a kid, like I made the mistake of my 11-year-old was heading out the other day and I didn't have cash for it. I was like, just take this credit card. All of a sudden, Ron John Surf Shop, $100. And I was like, babe, like, how long do you think it would take for you to work to make $100? And there was just no concept of it yet, right? My point is this: like, if you start with installment, I am driving my car. Do you understand that this car has worth, and that without this car, your life would suck significantly more? Yes. Well, understand then that there are payments that have to happen and actions that have to happen, right? Credit cards are still, I think, just a little bit too pie in the sky for somebody at that age. And maybe I'm just looking at it through my lens, but I know that I did not value credit card money at that time. It seemed like something I will deal with later. And that's at that age what I really like to do, was deal with things later. So
yeah. Okay.
Well, I would love to pivot a little bit because I think that our stories are so important. And I think that it would be really cool for our audience to know a little bit about your story, and most specifically, how did you end up in this business?
Yeah. So at first, it was just kind of by mistake. I was in between semesters at college, not feeling a ton of value or direction, honestly. Like, I kept flip-flopping between majors, just didn't really know what I wanted to do. Jesse Brecht, who you guys know, who luckily is on our team now, he actually recruited me to be a telemarketer, which I did well at it, just as a nighttime job for MCI, selling local and long distance services. And then we got recruited to run sales and marketing for a financial startup company. I was like, this is what I would want to do anyway with my whatever degree I get, right? And so I quit school and I went and I reported to this job. And all it ended up being was that we were the only 2 telemarketers for this company, and we didn't even have a computer. Like, they just put paper in front of us and said, these people have less than a 600 credit score. So we were calling people at their house and being like, I know you got bad credit. They were upset with it. So I pivoted that a whole marketing strategy and was like, I'm just going to start talking to lenders, because we have to have motivated clients, because otherwise nobody's fixing their credit until they have to. It's just, unfortunately, one of the things that's kind of true. And so we kind of pivoted. That company didn't like that because what they didn't tell me was that they were trying to run a mortgage company out of the back of it, and so I was creating leads for them. So I left after about 9 months, started a company called American Credit Repair, sold that after about 3.5 years, and along the way Trish had joined us, and then we worked at a company for about 6.5 years, and things just got a little wild there, where women especially were being treated horribly, and it just came time to put our foot down and leave. And so we left, we moved to Arizona, and it took about 5 days after leaving until we were served with, I believe it was 67 counts of non-compete, non-solicitation, non-inducement, just all this stuff. And then this guy took the next about year trying to hit us with injunction hearings and different stuff just to break us. That was the strategy, was to run us out of money. And he was really close, but we ended up getting through that, winning in court. And I can't say, the end amounts or anything other than I never wrote a check, and I was happy to get one. And we came out of that. And at that time we were a 2-person company working out of the den of our office in Arizona. And after that, it was, that cut the cord, and we were able just to really build something special after that. So that's the long answer.
That's amazing. So you talked a lot about non-negotiables, which leads right into the culture of the company you've built and how important the people who work with My Credit Guy are. But I think also, knowing you, I know that there is a why here, right? There is something to the concept that you recognize the psychology of the customers that you're working with. You've taught every single person that's a part of the My Credit Guy team the same philosophy. What is the intangible ROI for you? Not the success of the company or the revenue or any of that. What's the intangible that makes it worth it for you every day?
Ooh, Jamie, good question. I love an underdog. I've always felt and identified as that person that maybe like people didn't expect the most out of, or kind of counted out. And so just when we are able to take somebody from feeling like, just trash. Imagine that. Like, I want to get my family. My daughters have outgrown their bedroom. I make enough money. I'm going to go get a home loan. No, you're not. You don't get one. You don't deserve one because your credit score is too low because you did bad things in the past. Like, oh my God, right? And then to turn that around to somebody either qualifying when they weren't going to qualify, or making that move up purchase, or saving the money that they need to save to avoid a bankruptcy, or there's just so much in that where it's just like, it's like slow clap, like, yeah, you did it, keep it up. And then they can apply all those, like, I'm big on like establishing templates in life. And it's like, look what you just did. Where else could you do that? Because all you did was you gave it, you cared about it, you acted like it, you took action, and then you saw it through. That works everywhere. Just keep doing that. So yeah, just that underdog story.
I love it. And I bet you get a lot of those little wins along the way where, I know one of my favorite things is first time home buyers. And even back in the early days of my career, too many decades ago to count, that payoff at the end where you have homeowners, people that couldn't get into a home and, lived in their garage. I shared the story at my Amplify course I took last year. Is, the day you realize that what you do matters, the day you realize the impact what we do has on people, lives, families, is a big day. It's the day that you realize that you're not just pushing paper. It's the day you realize how important what we do and how we do it really is. Brad.
I think, look, Sam, a lot of really great practical knowledge. Keep doing what you're doing. And I love the fact that you've got an app coming out. Give us information that we can post below this episode when we push it out there. And we'll put some links there for our listeners. But keep doing that. The education is so important. And then the action that can take place after that. We like to finish up with a question that Jamie likes to ask. So no prep for this. We didn't tell you this was coming. But yeah, Jamie?
Yeah. So we just got done talking about people's past and how decisions they made early on may still impact them with their credit today. If you could sit down with 20-year-old Sam Parker, knowing what you know today, what would you say to him?
Man, I'd probably say just stick with the Orchard Bank card. You don't need the first Premier. And then at a higher level now, I'd say just go with your gut. I think that's luckily I'm impulsive, so I've done that, but it would have been cool to have that reassurance along the way. So yeah, just there's a few little things I could have avoided that made life much more painful down the road. Like just a little thing like not paying that first Premier card. I didn't start off with great credit, right? Or taking out they're called Parent Plus loans, but they actually require no parent for student loans. And I took about $30,000 worth of those out just to focus on my education those first couple of years. So there were just some little dumb, impulsive things that I did that I would take back. But then on the flip side of that, I'd be like, just go.
Yeah.
Go with your gut.
Instinct.
It's rarely wrong when we listen to it. That's amazing. Well, Sam, as always, it is an immense pleasure to sit down and talk to you anytime we have an opportunity. And thank you so much for coming in today and chatting with us on our pod.
Thanks, Sam.
I appreciate you. See you later.
Get Real 411 is hosted by Brad Rice and Jamie Kavanaugh, produced by Stuart Jellin, and recorded live from the AmeriFund Home Loan Studio in Simi Valley, California. You can learn more about the show at getreal411.com and watch full episodes on YouTube. If you're interested in being a guest on Get Real 411, email booking@getreal411.com. Please subscribe, rate, and review us on Apple Podcasts, Spotify, or wherever you get your podcasts.